You've found the FarrCast, your weekly podcast with conversations from across Wall Street, Washington, and the world. And now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. It's the 21st day of November. We're almost finished here. 6 weeks left in the fourth quarter, which also means, folks, there's 6 weeks left in 2024. Get ready to write a new 2025 number on your checks if you still write those things anymore. Coming up with a new year, 2025. My father was born in 1925, so here we go, Dad. We'll see if we can start planning that 100th birthday here. Can't wait. Futures are up this morning, and we've had a bit of a settling in since the initial surge post-Trump election. I called it a relief rally because suddenly in this very close election, investors didn't know whether we were going to have a Harris presidency or a Trump presidency, and they had to wait on the edges of their collective seats to figure out which sort of list of stocks and other areas they were going to support and what they had to sell. And money shifted quickly. Markets went higher, and they're settling down a bit. I spoke at a conference this week for the CME Group, and I was on the same panel with Anthony Scaramucci. And I was asked by our moderator, Guy Adami from CNBC, a great long-term contributor, Fast Money, 5 o'clock, great show. He said, Michael, give us the overview, please, of the markets. This is the question I am always asked, and I'm typically the lead off because I'm the markets guy, right? So I said, look, markets are high, period. Stocks in the S&P 500 are 22 times earnings. That's well above historical averages. The economy is doing well. It is slowing a bit, and inflation is slowing a bit. We are at a time where I think caution is warranted. This is not a time when you take all of your chips and shove them to the middle of the table. This is not a time when I would increase bets. I would be harvesting tax losses in portfolios, and I might be very patient with the redeployment of that cash. Just because you make a sell decision that follows your discipline does not mean you have to make a buy decision. So I said, look, things are looking that way, and I'm feeling a bit cautious. Goldman Sachs a few weeks ago came out and said they think 3% returns for the next 10 years, though on Monday afternoon, they came out with a report and said, different analyst at Goldman, said we expect 11% earnings growth, stock returns for 2025. All right, folks, if you're at 22 times earnings, how do you get 11% gains? You either get a multiple expansion or you get earnings growth. And in this kind of an economy, you might, if you get that kind of earnings growth, that would also imply, I think, some inflation. So there's a double-edged sword here. We have to be cautious. Anthony Scaramucci said, Farr, you don't get it. We've got AI. We've got GLP-1 drugs. We've got things that are going to change the entire landscape that add productivity, and you're being much too gloomy. I said, yeah, Anthony, maybe so, because I believe truly that AI and the GLPs and other things will change and add to productivity, change the investing landscape, change the future of our country. I really think they're that big. I think it's going to happen. I just don't know that it's going to happen in a material way in the next 12 months. And I said and told this audience, after my, 30, I can't even remember how many years, almost 40 years in this business, I've stepped in a lot of quicksand inadvertently. And I try to avoid those paths in the future. I've made a lot of mistakes, and I try to avoid making the same mistakes twice. So when I feel risk, when I see high numbers, I become cautious. And yes, everything might work out wonderfully, but I'll always make the error of being cautious. I can always apologize for being overly cautious to my clients. What I can't do is say, geez, Mrs. Jones, I had your retirement plan and very risky stuff because it was doing well, and I'm sorry it's down 30%. No, that's the never go-to for Farr. I can't live with myself. The Jesuits assured me you go to hell for stuff like that. When I want to avoid hell, ladies and gentlemen, which I I do. I don't think about it too much. But when I do, and I want to avoid it, I call my friend Jim Lebenthal. I think everybody should, frankly. Jim Lebenthal will cheer you up, will give you reasonable answers and input and some often pretty brilliant ideas about how to navigate your ways around hell. He's a partner at Cerity Partners, a CNBC contributor. Welcome back, Jim.
You always give me the kindest introductions, Michael. My whole day is going to be wonderful
Dude, you're
just
the
for the way
best.
you described me. Thank you.
You're the best. You're the best.
I'm always happy to be on with you.
I just might start referring to you as Beatrice, Beatrice. Okay, folks, literary reference. Those of you who got it, congratulations. Beatrice, when we found out that Dante moved out of the Inferno and into the Purgatorio, and he made it about half the way up the Purgatorial Mount, reason could no longer lead him. He couldn't climb any further, and he needed grace. And grace came in the form of an angel, a woman, his girlfriend, Beatrice, was there in Florence. And that's where you get beatific from, by the way, beatific, beatitudes, all that stuff, Beatrice. So he is, I'm just going to start calling Lebenthal Beatrice. See, you listen to the FarrCast, you don't know what the hell you might learn. So, Jim, are we going through purgatory right now, or are you feeling more like the Paradiso this morning?
Well, I'm not sure what level or circle we're in, but it's probably closer to elation. I'm not going to call it elation because there are some risks out there. But as far as the markets are concerned, things are pretty good right now. When you step back from the election, you've got to paint the backdrop before the election. We had and still have a very strong economy.
Yes,
We've
sir.
got excellent employment. We've got inflation coming down. Obviously, I'll come back to that in a second. The Fed's cutting rates. China is stimulating its economy. And yes, there's reasonable questions about how much or should the Fed even be cutting rates. And there's reasonable questions about, is the stimulus that China is enacting enough? But that's a very powerful backdrop. It's a very powerful backdrop. So it's not a mystery why the markets are levitating. When you add to that the very pro-growth policies that are likely to come after this election, it's no wonder that the stock market has, as I said, levitated. And let's face it, who wants to sell stocks right now? If you're a taxable investor, you don't want to take gains, and there's very little in the way of tax losses. If you're an institutional investor, you dare not sell stocks. You dare not. I mean, you're not going to just, lick your finger and stick it in the wind and say, oh, I think the market's going to go down today, because you're more likely to be wrong than right and find yourself behind the benchmark. So the end of the year, which is drawing fast upon us, looks pretty good for this market. And those policies, I think, are going to promote things into the first quarter of next year. Eventually, we've got to worry about inflation. I mean, there's many reasons to worry about inflation. That's the risk I think we've got to worry about. We'll keep an eye on it, but I don't think that's a problem until second, third quarter of next year.
Here's my question. If we have the pro-growth policy, so if we have the corporate tax cut that President Trump wants, and maybe a broader tax cut that President Trump wants, and he wants lower regulations and more energy drilling. We're producing more energy than we can use right now. We have solved that problem, thank goodness, for the United States. But he's also talking about tariffs. And Greg Valliere wrote yesterday, believe him when he says he's going to have tariffs. There were other analysts yesterday who said, don't doubt the tariffs that are coming. Is it possible that we have a balance here, that we have a balance where the tariffs, which are indeed a tax, I'm telling you, any business person, economist, you don't have to be an economist to understand how a tariff gets to be a tax. So with the tariffs, is there enough of a foot on the brake on one side and enough on the foot on the gas on the other side that the economy kind of simply gets reshaped and nothing too dramatic happens?
I like the way you described that. As I was listening to you, I wanted to say, yeah, I believe that. Unfortunately, I don't. And
We're
I don't
never
mean
that lucky.
No, I don't mean that in a saucy way.
I like it when you're saucy, Lebenthal. Everybody likes it when you're saucy. Come on.
Okay. Well, I think I'm just being rational this morning. It's still early for me. But, again, before these tariffs are put into place, which are number one, inflationary, number two, as you said, they're paid for by the consumer, i.e. they are a tax. Before those are put into place, think about what I said a second ago. We're cutting interest rates into a 4.1% unemployment environment. We've got fiscal spending. I forget if it's 6 or 7% is the deficit as a measure of GDP, but it's high. It's very high at full employment, and it's likely to continue on the back of already enacted legislation, and there's really no brakes on that. So I put that all together, and I would say even before you get to the tariffs, you've got an environment in which inflation, while it's coming down, is likely to reverse course. Now, I don't want to completely make my bet on this comment because the issue is it is coming down now, inflation, and it's likely to do so for a little while longer. The question is, when does it rear its ugly head again? At the most core level, all of us consumers, whether you're high income or low income, are alarmed by the prices we're paying. I don't care if it's an oil change at Jiffy Lube. I did that the other day, and that was an eye opener. I don't care if it's a haircut. I don't care if it's an airline ticket. Whatever it is, we're all looking at these prices and we're saying, what the heck is going on? The way that eventually comes out is more wage pressure. People saying, you got to pay me more. You know, the Jiffy Lube costs twice as much as it did before. You got to pay me more, and that's where the wage price spiral gets in. I think you're going to see that again in the second half of next year.
Let me push back a little bit on the interest rate cut idea, and then I want to go to the street's reaction to NVIDIA's earnings. We're not going to recommend anything about NVIDIA. We're just going to discuss that reaction. But I want to push back on this idea of cutting rates, because I think that Jay Powell would say, I'm not cutting rates. I'm basically just stopping the increase in rates, and I'm doing it in a material, demonstrative way to say, okay, I went high. I got the result I wanted, and now I'm just going to now I'm going to stop. I'm going to lower rates here, another quarter of a point, and I'm done. And I might not even do that, but I'm going sideways. I'm not trying to do anything that's in any way stimulatory, nothing stimulatory. I'm just think that we found the right level. I'm just making a tweak here, and this is not stimulus. What do you think about that, Jim?
Well, I get what you're saying. First off, if it's just one more rate cut of 25 basis points, fine. I don't think that's where the Fed is. I think they're going to go more than that. That's what I'm worried about. And the reason is, Michael, and this is it's tangential, but really on par with what you're saying, is that the Fed's saying, look, inflation is around 2.5%, 3%. We're at 4.5% on the Fed funds rate. So we're restrictive by their definition. And then, of course, there's this whole ephemeral concept of what R star or the neutral rate is. I don't want to get into that. Here's the basic message I'm saying is the Fed thinks it's restrictive right now in terms of where interest rates are. I'm not so sure. I mean, look at gross domestic product, how rapidly it's growing, 2.5% to 3% for several quarters in a row. That looks like where we are this quarter as well. I already mentioned unemployment. This economy is doing just fine. And that gives me reason to think that maybe the Fed funds rate isn't restrictive at all. But to just go back to where you said, if it's one and done from here, I think we'll be okay.
Jim Lebenthal is a partner at Cerity Partners, CNBC contributor, and my great friend, who will, I promise, lead you out of hell and despair whenever you need him to. Jim, thanks so much for being with us.
You're too kind, and I feel more literarily enhanced today than I did when we began.
Don't know how I got there this morning. Must have woken up on the literary side of the bed. Coming up, Dan Mahaffee. When we come back on the FarrCast, please stay with us.
You can hear the sound of surf guitar, which means that it's time to go to Chicago, surf capital USA, and our good friend Dan Mahaffee. Now here's your host, Michael Farr.
Welcome back to the FarrCast. Dan Mahaffee joins me now, as he does every week, Vice Chairman of the Dr. Scholl Foundation, a scholar at the Center for the Study of the Presidency and Congress, a Washington, D.C. think tank where he directed policy for a number of years. The senior political analyst on the FarrCast, now in Season 8. Welcome back, Dan.
Good morning, Michael. Thank you. Great, as always, to be talking to you.
Thank you. We really learned so much, Dan. Russia fires ICBM at Ukrainian city in latest missile escalation, Kyiv says. That's in the Washington Post this morning, fired a ICBM at the city of Dnipro. I'm sure I'm saying it wrong. Dnipro, and it's a eastern Ukrainian city. Picture in the Washington Post shows a building with its roof caved in, something like you would see after a tornado had been through. Didn't look like the remarkable devastation you'd associate with an ICBM. So, Dan, this is heating up. How serious is it that Ukraine now has permission to send U.S. missiles deep into Russia? Russia's sending ICBMs back. Tell me what you make of this.
Yeah, look, I think we've seen some escalation, and look, let's take a zoomed out moment on this. We've seen escalation from both sides, as I think both are trying to position themselves for what they see as the inevitable shift to some kind of peace talks or dialogue that will happen after Trump is inaugurated in January. So you see this kind of jockeying for new lines, new positions, as well as with the introduction of North Koreans into the conflict, some of the restrictions on our Western weapons, provided the Ukrainians gone. And we now see this, whether it was an ICBM or something medium range, let's separate out. When most people think of an ICBM, they think of nuclear World War III, the beginning of Terminator, those kinds of scenes that we have from pop culture. This could have been something that is more of a theater range missile or medium range, the kind that perhaps is designed to strike from Russia to, say, London or Brussels or those kinds of targets. But what we did clearly see is that it had a multiple warhead package. So it did come in with these multiple entry vehicles. And that is something that does say they're signaling a more sophisticated weapon could be used, and one that, because we're talking about it, does have these psychological connotations of World War III. And that probably is the biggest effect they want from it, that we are talking about it and thinking about this escalation.
Okay, strategically, Dan, President Biden gave permission and authorized this after his 2-hour meeting in the Oval Office with President-elect Trump. Could this be a strategy that came out of that meeting that said, go ahead, heat it up, give him permission? Trump approved of this. I'm making all this up. Trump approves it. He comes into a hotter situation and has better leverage to go ahead. Or is this President Biden throwing his last few Hail Mary passes on his last days as a lame duck?
Yeah, I think the charitable explanation is that first one, where it is Trump and Biden agreeing. And look, Trump, whether or not they agreed, probably should be thankful that Biden has given him more bargaining chips to use in this eventual negotiation. That said, though, the likelihood, I believe, is that they saw that this, and you look at the rhetoric of, say, Donald Trump Jr., who says that, tweeted that Zelensky's allowance will soon be cut. I think that's the term he used. The rhetoric of others close to Trump, Musk and others. You see that the writing is on the wall for the Ukrainians in January. And, I think it's awfully belated by the Biden administration, but might as well take the shackles off while they can. And also, I think, frankly, send, if we're thinking about this more broadly, a signal to China, frankly, about this North Korean participation and what that means for the West in terms of how we see it.
I was listening to a speech this week by a very highly placed former government official, very, very, very highly placed government official. And he was talking about the North Korean army, the 10,000 troops. He said these people are undertrained, undernourished, and are nothing more than cannon fodder that will sort of delay and occupy the Ukrainian troops. But it's just an awful shame what's happening there. And he also suggested that if Putin were to actually use some sort of tactical nuke, it could be the straw that sends China packing from the support that they've been providing. What do you think about that? And I've got to move on, Dan. So give me, and I want to know, Dan, as you comment on those two things, I also want you to give us your opinion on whether we actually get to some sort of negotiated truce in the next 6 to 12 months.
Mm-hmm. Yeah, first to start there on the regarding the North Koreans as cannon fodder, that's exactly what they are. But cannon fodder, the mass of troops being used is designed to simply overwhelm Ukraine as it runs out of its own personnel and runs out of weapons as the Western nations, drip them slowly and slowly rather than surge them to Ukraine. So cannon fodder has its own value in this war as well as the Russian style of fighting throughout their history. They fight in mass. On the idea of negotiations, I think you do see it happening because we are seeing the cracks forming in the Russian economy, even though they've moved to this war footing. You see them now approaching perhaps 1 million casualties in this war on the Russian side. Ukraine, as we see now, going into a winter where they are without anywhere from 1/2 to 2/3 of the electrical power generation they need. All these facts and figures, as well as the political winds changing both in Europe and the United States, make it highly likely that we have some kind of negotiation. And then from there, we need to figure out what is the next strategy and ultimately understanding what are the lessons from this conflict to prepare and deter for the next conflict. Putin has talked about Finland. He's talked about the Baltics. He's talked about other places. And how do we build a strategy understanding, one, that yes, Europe does have to take more of its defense into its own hands. And two, what does this, for lack of a better term, new Cold War look like with a new DMZ that goes from the Arctic Ocean to the Black Sea to keep Russia deterred and at bay?
This former, very, very, very highly placed government official also said that if Putin is not stopped here, he will not stop. If he is not stopped here, he will not stop. So
yeah, that is clear. And I think to that final question of how do you stop or what is it? Look, we talk about nuclear. You asked about Xi. The Chinese have repeatedly said that nuclear use is a red line in this conflict. So that idea of if Xi Jinping's support for the war depends on that nuclear taboo, sure. But again, we've seen Russia move through some of these red lines, as we said, with this North Korean deployment to the front.
Okay, Dan, let's take a look at the appointments, to the cabinet appointments that President-elect Trump has been making. Some seem kind of outrageous. I gave a speech Tuesday with Anthony Scaramucci, who suggested there were really two types of Trump appointments. Those that were revenge appointments going to loyalists, and then there were the other appointments that were more qualification-based in areas that President Trump was less concerned about. What do you think is going on with these appointments? Will Tulsi Gabbard, Hegseth, and others actually get confirmed?
Michael, I think there's going to be some senators who still really take the advise and consent role seriously, and that these picks, and particularly if they're trying to steamroll through some of these norms like the FBI background check and other things that have sort of long been held as requirements for nomination. Politico, if you look and trust them, they have a list here of about 11 Republican senators, and I think really good sound reporting and research on why those 11 senators have various reasons to oppose these picks. Certainly ones like McConnell and others who see themselves as stewards of the Senate, but others like, for example, Joni Ernst from Iowa, who could just as easily want to be Secretary of Defense herself. So there's lots of reasons for these senators to oppose these picks, and the way the administration is approaching them is giving ammunition to this. I also think you need to pause for a moment, and the conversation needs to be had. They're getting some very qualified folks further down on the benches from the transition list they've planned, but these top folks seem to have also the common factor that they've been television celebrities, others that Trump would see coming out of central casting. That said, they are going to go into these positions where the management of an agency and the issues you have coming over the transom and the bureaucracy you have to manage. This isn't a partisan statement, simply the logistical and management difficulties of running these agencies I think will overwhelm people who have largely been used to sitting in green rooms and having their talking points made by producers for them.
Does this when do we see these folks get seated, and will Trump use recess appointments?
I think this body is not going to adjourn in a way that will allow him to use recess appointments unless I think for some of these more minor positions. I think when you again, we have to remember that this will really start to move in January when the new Congress is seated. So that's when these conversations and discussions will really start. Right now, too, just for the listener's sake, keeping an eye on the discussion. We're a month out from the budgeting deadline, so they still need to get a deal done on that. Tracking that on the Hill, you have the question of do you get a longer term deal, which I think would be the smart thing, though plenty of Republicans want just a short term measure. And frankly, my analysis, that doesn't make much sense to me, because why tee up a government shutdown early in the Trump administration when you control both houses? All you're doing there is setting yourself up for a conflict you don't need to fight.
Dan Mahaffee is a fellow at the Center for the Study of the Presidency and Congress, the vice chairman of the Scholl Foundation, and our great friend here on the FarrCast. Coming up, our special segment with Bryn Talkington. Stay tuned. Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. We appreciate you listening into the FarrCast this week. And now to introduce this week's special guest, here's your host, Michael Farr.
Welcome back to the FarrCast. We're so glad you're with us again this week. It is the 21st day of November, coming into the end of 2024. Can't believe it. Happy Thanksgiving, everybody. We'll have a special Thanksgiving edition of the FarrCast. It'll be a bit briefer. I heard you all smile when I said a bit briefer next week. Okay, joining me now, a FarrCast fan favorite, Bryn Talkington, is a managing partner of Requisite Capital Management. She's a co-founder of Requisite Capital Management. She has more than 25 years of experience. And I've got to tell you that because if you look at her on television, you'll never think she's done anything for 25 years. Really looks like she just got out of college. And she's done everything in the business and UBS and big firms, little firms. And one thing you'll get when you watch CNBC is Bryn Talkington gets it. She gets it, folks. So we really appreciate you being with us and helping us sort through all of the noise today, Bryn.
Oh, Michael, always such a pleasure and such a treat to be with you guys. So happy to be on here before Turkey Day, week before Turkey Day.
Yeah, this is pretty good. Well, we all have so much to be thankful for. We're looking at markets still near all-time highs. And we're looking, here's something I want to start with, Bryn. The top 10 stocks in the S&P 500 now represent 36.8% of the S&P 500. Top 10. So 36.8% in 10 stocks. That's the highest concentration in 60 years. Highest concentration. We've run concentrations for a lot of years, and the top 3 stocks in the S&P 500 represent 20% of the index. Do you see this as any kind of a sign? Because the last time we saw this was with the Nifty 50 going back to the early 1970s. Does this kind of concentration represent risk, or is it just the sort of new paradigm, if you will?
Well, if you look at the top 10 companies, I'm going to be directionally accurate. Maybe they're 36%, but they're about 25% of earnings. And so, and if you look at the multiples, these companies are not, I don't think, akin to the Nifty 50, because if you remember in the late 60s, the Kodaks, the Polaroids, the PE on some of those stocks were insane relative to the time period.
Do you see the way she did that? She said, if you remember. Well, of course, I remember. He's read about it in history books, folks.
Yeah,
but I do. Yes, okay, to answer the question, yes, I
Yeah.
remember. Go ahead. I'm sorry.
Right.
And you're right. They were.
I think it's it's an interesting note, but like even when you look at, NVIDIA, whose earnings came out last night, the 3.1 trillion. I mean, NVIDIA is trading at the median of its 3-year PE, right? And so NVIDIA, even with this massive growth, is not even remotely as expensive as it has historically been when you're looking at like the average 3-year multiple of the stock. So I just think we're in this unique period of time where these big names, the Microsofts, the Amazons and Apples, the cash they generate, the earnings they generate are just exceptional. I think they're warranted to be those names in that top position.
There is still growth there. And the really important point that Bryn's making is that if price gains are driven by fundamentals rather than multiple expansion, right? Multiple expansion is more a sign of sentiment than anything else. Earnings are earnings. And if you're looking at real dollars earned and the earnings growth is actually driving a good deal of the stock price growth, fundamental investors feel a lot better about that. I'm going to give you one more for our listeners, and Bryn probably knows this, but in the early 1970s, the small caps were trading at around 8 times earnings or 9 times earnings. And that didn't feel stupidly cheap back then. We thought that 14 times earnings was pretty much what the PE should be for the Dow Jones Industrial Average. And we were all talking about the Dow Jones Industrial Average. And back in those days, if you owned AT&T, telephone, you knew what was going on in the stock market. It was we talk about telephone every night on the television, up a quarter, down a quarter, off 5/8 back in those days. But the wisdom was, look, you've got the Nifty 50 trading up at 50 times earnings. Small caps are 8 times earnings. That gap has to close. You have to buy small caps. And indeed, a bunch of people bought small caps. You're hearing that again today, by the way. And what happened? The gap was closed. The Nifty 50 came down to 8 times earnings. It was awful. And it took years, and it was a constant drip in the 70s through the mid 70s of this rolling bear market that wouldn't end. You were okay in the small caps, but basically they stayed at 8 times earnings and you didn't have that big pop. So maybe these stocks come down, maybe the gap gets closed, or maybe this time it goes up. What do you tell clients when they are concerned about the political environment and they're seeing markets trading at highs? They're seeing good numbers out of earnings. They saw an ICBM launched overnight into Ukraine. There's so much to be focused on, Bryn. How do you sort through it?
I think that we try to be factor-based, statistic-based investors and do have some perspective. I think that when you just look at the rich history we have in the markets, that helps trump investor behavior. And so, I'll give you a good example is that, we've had 2 really good years.
You don't mean Trump investors. You mean actually supersede.
But I thought I was being funny.
Okay, sorry.
I thought I'd throw that in though.
We got to qualify when we start throwing the Trump around as an adjective these days.
Right, I know. And so, what we do get questions is we're at an all-time high. What do we do now, right? Yep. And so we've had a really good few years. But if you look back and say, well, can we string together a third year, right? Because we remember 2022 was down, so 23 was up, 24. So the question is, can we string together another positive year? And if you go back for the S&P and the NASDAQ, on a rolling 3-year basis, the S&P is up 3 years in a row, 84% of the time. The NASDAQ's 82. And so the probability that we have a positive year is very high next year. And so I think when you look at that, you would say, okay, 3-year returns are actually very common. Where you want to be nervous is that when you have 3 years of the S&P and you get a double in that or the NASDAQ, meaning in that collective 3 years, which you saw from September of 84 to September of 87, the S&P was up 100%. You also saw that in the NASDAQ in the 97, 98, 99, also up 100%. So when you get those 3 years have such energy to the upside, that's when you want to say, hey, take a step back. Historically, this has not been a good time, but we are not even near that. So I'm actually quite constructive on the markets, just looking at that one statistic. And I also think that we're going to get, I think after the inauguration, I think there's going to be just like a lot of green shoots economically. We need earnings to do their thing, but just economically, I think there's going to be a lot of optimism around US equities, around the market caps, mid cap, small cap, large cap, just because of, I think, the deregulatory environment and the positivity after the inauguration.
Goldman Sachs came out Monday afternoon and said 11%, which was weird because I was on CNBC a few weeks ago when Goldman came out with their 3% for the next 10-year returns, and I thought that was too Malthusian. I understand the math, but just too Malthusian. 11% was the number Monday night. Does 11% sound like a fair number to you for 2025?
Well, I would say no, because if you actually go back and look, since 1929, the S&P's done what, 10%?
Yes.
10%. How many actual calendar years? And we did this study and we were pretty liberal here. We said +2, -2. So between 8 and 12%. How many times in 90 years, basically, has the S&P actually done between 8 and 12?
4?
4 times. It never happens. So I would say no. Statistically, I would say absolutely we will not do 10% next year.
I only guessed 4 because we did the same study 2 years ago, and that was just a test as to whether I could remember what the hell we found out too. But yeah,
it's good though, right? The analyst, when some analyst says 8 to 10%, which is the long run average, markets just don't do that. They either overshoot or undershoot. So I think statistically we have a positive year, but I don't think it's going to be 8 to 12%.
I'm going to do a quick shift with Bryn, ladies and gentlemen, because I want you to understand who we're talking to. I've criticized financial television over the years. In this, there's a trend over the years where they now have financial reporters who will interview financial reporters. And I always used to yawn and say, I really don't care what the reporter. I mean, yes, you hear some really good studies, and they've done some Googling and research, and there are facts there. What I really want to hear are from the people who are managing real money and talking to real clients and have to place their bets every day. And bets is an unfortunate term. Place their investment, make the investment decisions, and live with them, and live with their mistakes and get paid or not get paid based on them. So Bryn, in 2017, with her partner, founded Requisite Capital Management in Texas. You manage real people's money. Would you tell us just a little bit? This is not an advertisement, ladies and gentlemen. I want you to understand what she does for a living and how she's held accountable. She's not just one of these TV talking head peoples. That's the side job. So would you tell us about Requisite for a second?
Yeah, sure. My partner Doug and I started the firm in 2017. We just felt there was a better way. We have around 75 to 80 families that we work with. We run around $2 billion in assets. And we're big believers that investors' portfolios actually shouldn't be all path dependent on interest rates moving lower and stocks moving higher to generate all of their returns. We're big believers in the private markets. And so our business is probably 50%, public securities, ETFs, et cetera, and then 50% private markets. We're based in Dallas, and, we have the benefit to get to wake up every day and try to improve client outcomes. And so that's where I do spend a lot of time as it relates to public markets, really understanding history, because when you do have these events, as you talked about earlier, our job is to keep clients in their seats long enough to earn the returns of the asset classes they're invested in. And I can't do that if every time someone on TV is like, the sky is falling, we actually don't have data to back that up.
Right. And so your average client relationship is $25 million. Is that right?
That's about right. Yep, that's about right.
Okay. And do you all have a minimum?
We do. We do a lot of private investments. So our minimum's 5 million. Just so from the SEC rule, you need to be a qualified purchaser, and so to be able to invest in private investments.
Okay. I'm going to give you one more. This is it's a fact, and if it sounds like a plug, that's not really, ladies and gentlemen, what I'm trying to do. I have clients in that 25 million, 50 million, 100 million, 200 million, $300 million range as individuals. You don't get those clients and keep those clients by just being run of the mill or being lucky or being a charming person over time. That doesn't cut it with those very wealthy, sophisticated clients because, yes, they're bright, most of them, not all of them, but they have a ton of people beating down their door all the time. Once you have 25, 50, $100 million, people figure that out. And people in our business get paid a lot of money to figure that out and to go after those people. So it's not just getting them. You've got to maintain those clients and those relationships, and you have to deliver in a meaningful way to the quality of their lives and to the quantity of their portfolios. So I really congratulate you guys on your success. You think about that since 2017. That's a remarkable success story, ladies and gentlemen.
Thank you.
The American dream. Congratulations, Bryn. So as we come into the end of the year here, and I can't believe we're out of time, but coming into the end of the year, Fred and Ethel, not necessarily wouldn't qualify for your client base. We have been on Fidelity's platform for 20 some odd years. And they've asked that we keep a $500,000 minimum for our retail clients, which we've done. People get scared and they read the news and they don't know what to think and they worry that they're going to have that money there when they need it to retire. What do you tell those people coming into the end of the year, and what should they be doing and thinking?
Well, I think you have to understand how much, your own risk tolerance. I don't think risk is good or bad. I think it's compensated or uncompensated, right? So just like understand, can you handle a 14 to 20% drawdown? Because that's just the price of admission for owning equities, right? The average drawdown is 14% any one time. But I just think, especially going into the end of this year and next year, there's going to be a lot of saber rattling. There's going to be a lot of changes. I don't think President Trump was elected to keep the status quo. And I think as that relates to equities, I think at the top line, equities can do very well. But I think individual sectors, I think it's going to be a little bit of a roller coaster, especially as you get, Elon and Vivek going through and trying to create, efficiencies. To me, where I'm going to look out is like the Raytheon, the Lockheed, and the Boeing, these zero bid contracts, which Elon wrote about in the book. They talk all about in his book with SpaceX's opportunities that they had to go against Boeing. I think things like that are going to create volatility in individual sectors and securities, but that's where you have a diversified portfolio, right? That we all know that you can weather the storm. But I do think it's going to be an interesting year. Like, I don't know who makes red dye number 40, but I think pretty much your business is going to be impaired next year.
Those aren't recommendations, ladies and gentlemen, either to buy nor sell any security or make an investment. Those are examples Bryn's using, and they're brilliant examples. Thank you very much, and God help you, red dye number 40 people. I don't think you're gonna have a very good year either. Okay, Bryn, thank you for joining us on the FarrCast. That's it for another FarrCast, ladies and gentlemen, as we cover Wall Street, Washington, and the world, bringing you experts and insiders to help us understand what's going on in the headlines and how it's going to apply to the U.S. economy and Wall Street. And folks, never bet against the United States of America, just never. We have dark days, we have bright days, but we have many more days, and we will remain that shining city on a hill. Over time, we will just continue to be aspirational and drive higher and harder than anybody else, because we're Americans and that's what we do. Thanks for listening to the FarrCast. Please share us on social media. We'll be back again next week with a Thanksgiving message. For Harry Jennings, our producer, everybody at Hightower Advisors and Farr Miller in Washington, thank you so much for listening. Share us on your social media. I'm Michael Farr. See you next week.
That's a wrap on this week's episode of the FarrCast. Thanks for being with us. And thanks to our guests, Jim Lebenthal, Dan Mahaffee, and special guest, Bryn Talkington. We'll be back with you next week with an abbreviated Thanksgiving edition, and then return to our usual format, bringing you insiders from across Wall Street, Washington, and the world in the month of December. FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Spotify, TuneIn, and Apple Podcasts. Please be aware that anytime we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, news headline, or economic trend, it is not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. In tumultuous times here at Farr Miller in Washington, we stay focused on dispassionate analysis and dogged research to serve our clients' interest and help them reach their investment goals, no matter what the political and economic winds may bring. If we can be of assistance, please reach out to me at hjennings@farrmiller.com, and I'll be happy to put you in touch with one of our investment professionals to help you navigate your financial course. We are grateful for all of your notes and comments and try to respond to as many as we can. Please keep the emails and messages coming. Take care, stay safe, and stay healthy. We'll be back with you next week on the FarrCast, Wall Street, Washington, and the world. Farr Miller in Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, and a SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr Miller in Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr Miller in Washington and Hightower Advisors, LLC, and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr Miller in Washington and Hightower Advisors, LLC, and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC, or any of its affiliates. Farr Miller in Washington and Hightower Advisors, LLC, or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.